is Ford Dubos with Cetane Associates, and it is my pleasure this morning to introduce Griffin Sharp and Danny O'Laughlin here at Cetane. And they're going to be helping us answer the age-old question, how much do you really take home after selling your business? And with that being said, I will hand the microphone off to these two gentlemen to help us get rolling.
Thanks, Ford. So just quickly by way of introduction, my name is Griffin Sharp. I'm a director here at Cetane, primarily focused on representing sellers in fuel businesses, but I've also been working in valuation, broadly speaking, for the last 15 years or so. So the items we're talking about today are things that I've encountered just about every day. And I'll pass it over to Danny.
Great. Thanks, Griffin. So I'm Danny O'Laughlin. I'm a director here at Cetane, primarily focused on pest lawn landscape. And also like Griffin, not 15 years, but I did 6 years of B-Val before coming over to the M&A world. So, um, we'll just jump right in from here and go through, all these pluses and minuses so you can figure out, what you actually cash flow at the end of it. Um,
Great. So we'll go ahead and get into the presentation here. How much do you actually take home after you sell your business? And let Danny take it away.
Do you go to the next slide? Um, Great. So yeah, typically you have your headline value number. We're not going to we're not going to dig into custom deals. We're just going to more standard. Typically, you have a headline number and that's for all of your assets, but these are the items that can move cash flow, up and down. Typically, net working capital is negotiated in some manner and is either an add or a deduct, depending on what was delivered at closing, because it's usually estimated. And there's 100 different ways to negotiate it, which Griffin's going to go through. Transaction costs, you have to pay the people who help you get to the finish line. Accountants, lawyers, brokers are the typical group there. And then finally, you cannot avoid the tax man. And so you will typically have to pay federal, state, hopefully not local, but if you live in some fun jurisdictions, you get hit with local tax too. And so we'll go through, the high level of all of these items. This is not meant to be personalized tax advice. I have to say that because I'm a CPA, and it very much is not. There's assumptions in here that are just totally made up. I think the main point of this is to recognize when you have, kind of how the chips will fall, and then when it's time to make a phone call to someone who's qualified. So I will pass it to Griffin to go through, working capital.
Yeah, so thanks, Danny. And it's important to note here that primarily we're going to be talking about asset sales because in the lower middle market, that's typically the way that a sale is structured. And almost anything under $20 million is almost always going to be an asset sale. And so we won't focus on stock sales or equity transactions here, simply because it won't affect most clients. So in an asset sale, it's important to discuss first, what are we actually selling when we talk about selling your business? And in an asset transaction, what typically is included are your hard assets, your things like equipment, vehicles, buildings, and land if you're selling real estate, as well as any intangible assets in your business. So that can mean trademarks, your brand name, your company name, perhaps the most important element, which is your customer list and customer data, as well as any software that's unique to your business or that you have licenses for. And also transacted are goodwill, which is effectively the value of your business over and above what's reflected on your balance sheet. And that typically is conceptualized as what are your customer relationships or your business reputation worth in a business transaction. And also transferred typically are your employees, though they're not a business asset, they are people, but they're not something that we typically consider as a source of value in a transaction that's specifically allocated. So now we also need to talk about what's not fully included usually in an asset sale, and that's really everything else on your balance sheet. So your current assets, like your cash, your receivables, inventory, if you have prepaid expenses, your current liabilities, which again, your payables, if you have accrued expenses or unearned revenue or customer credit balances. And then, of course, other liabilities, which typically that'll be debt, vehicle notes, term debt, capital leases, or if you have other types of long-term liabilities. So we're going to be focusing here on those other not fully included items, which are what Danny kind of termed as working capital items here. And I've kind of laid out here for you the way that a lot of these working capital items are typically treated in a sale and where they can be sources of value and reductions in value in a business transaction. So we'll start with your current assets and start with cash. And that's pretty simple. That's yours to keep in almost every case. That's money that you've already earned in the business, typically already been taxed on. And so that's something that you simply sweep off the balance sheet and that's yours to keep. In theory, you could sell it with the business, but you would just be paying, you'd be paid dollar for dollar for the cash value. So it would be no different from just keeping it yourself. Also pretty simple are prepaid expenses if you have any of those. You may have prepaid rent or insurance or other items that will benefit the business going forward. And because the buyer is getting the benefit of those prepaid expenses, they'll typically compensate you at a one-to-one basis for it. So that's a straight addition to the purchase price in most cases. What can be typically a bit more complicated are accounts receivable and inventory items, as well as other potential current liabilities. So we'll get into some ways that things like accounts receivable and inventory can be handled here. Now, AR, of course, is the money that you've earned but haven't yet been paid for from your customers. So a couple of different ways that this is handled in business transactions are what we would call maybe collect and remit, or purchase either at face value or at some discount. Now, that first option of collect and remit involves a buyer collecting your AR on your behalf and then sending it back to you as they get it from your customers after the close. This can be nice in that it takes the burden of collecting off of your side and gives it to the buyer. And that if a buyer is particularly good at collecting from customers, you might get more out of this AR than you would have yourself. But that being said, a buyer may not be as incentivized to collect that ferociously when it's not for their benefit. So you have to consider how good will your buyer actually be at collecting for you. The second option of purchase of your AR at some discount to face value can have benefits as well. Typically, your current AR will be purchased at 100%. Maybe your 0 to 30 will be at 90%, and some declining scale from then as far as you're further out ager. But what's nice about this potential option is that you get paid typically right at the close. You don't have to wait 30 or 60 or 90 days to be paid for your AR. But at the same time, we should recognize that a buyer isn't doing this as a charitable option. They're going to structure the schedule in such a way that they think they'll come out ahead on the discount schedule. So when you're thinking about a purchase of AR at a discount, you're going to want to negotiate carefully to make sure that you get full value for your AR. The second piece in your current assets that we'll want to think about is your inventory. Now, most buyers will want to keep some level of inventory in the business, and so this will likely be subject to some minimum level of inventory. And you may run particularly light, depending on what kind of business you have, or you may have a very fully stocked parts and supply room. It really can depend on the business and on the owner. But this can be a significant source of value in my experience that you want to make sure that you're not just being flippant about. So different ways that this can be handled are what we would call post-close count and valuation, or as a stipulated value. And a stipulated value is very simple. It's just you agree on what you think the value of the inventory that you hold is with the buyer, and they pay you for that, typically right at close. And again, that has the benefit of immediacy, but at the same time, you want to make sure you have a good idea of the actual value of your inventory, because in many cases, once you start counting up all the little parts and fittings or little bits and pieces on your vehicles, it can add up to a lot more than you think it does. And so you don't want to leave money on the table there. By contrast, the post-close count and valuation is exactly what it sounds like. You and the buyer would go through all of your inventory after close, count it, and value it at usually at some portion or all of the price that you could buy the items for at a local parts house. So this can be positive in that you can get more value out of your inventory as an addition to the purchase price. But at the same time, it's very tedious. Nobody really likes doing it. And it can be contentious in deciding how should something be valued? Will the count be fair? And then, will the buyer give me credit for all of my inventory, or will they try to make big haircuts for what's called usable or saleable or obsolete inventory? These can be points of friction, especially post-close and for a true-up. And then, of course, you don't get paid for this until the count and the valuation is done and agreed upon. So there's a lag here as well. So we'll want to make sure that when it comes to the negotiable items in current assets, we think carefully and negotiate hard to get the amount that you want to, in addition to the purchase price. Now, of course, there are also current liabilities on your balance sheet that aren't accounted for in the purchase price. And these, like accounts payable and accrued expenses, are typically handled in a pretty straightforward way. These are credits against the purchase price, that is, deductions from what you're being paid. These are liabilities that you owe out to other people, whether they're to employees or to vendors, or accrued expenses for obligations that will come up and be assumed by the buyer. And so therefore, they're going to be credited against the purchase price or paid off prior to close by the seller. So that's pretty easy and easy to handle. What's a little bit more complex is customer deposits or items of deferred revenue. You may hear these referred to as customer credit balances. And so there's, again, a couple of ways to handle these, and a lot will depend on what they're for. Usually these are liabilities that are related to maintenance plans or service plans that you may offer to customers, where you have some obligation to them for the money that they've provided you up front, and that obligation is further out in time. So in cases where there's a single defined obligation under the deferred revenue item, that is, you have to go and provide service to a customer at a defined date in the future, and you haven't done that yet as of the closing, that is an outstanding liability that the buyer will have to assume, and they'll want a credit for that quite fairly, I think. So you will want to credit the deposit amount to the buyer against the purchase price in that instance, because they're taking on a liability from you that they have to perform on. Now, your maintenance or service plans may also be a little bit more complex, where there's some obligation that you perform, but there could also be ongoing benefits like discounts on materials or labor, or other potential future follow-up work that is contingent on one thing or another happening. And in that situation, really what you try to hang your hat on is the required single obligation or whatever obligations are contractual under the agreement. That is, if the only thing that's really promised is a tune-up or a single service, then you determine, has the service or the tune-up, the one required item, been provided to the date at the closing? And if it has, then you're free to really retain the deposit or the customer credit balance in that instance. But if that obligation hasn't been performed on at the closing, you will need to provide a credit to the buyer to perform that obligation. So that's really the way that you kind of can carve that up and make sure that you're not giving credits that you don't need to in those instances. So those items are your current assets and current liabilities. And the net of those, and we've got some example figures in here, you'll see is 350,000 in this case. And that's what we refer to as, I'm sorry, that's your current liabilities is 350,000. Your net working capital, which is the difference between your current assets and current liabilities, in this case is $725,000. So that's kind of the net here. That's the addition to the purchase price that you're getting out of these different buckets that aren't included in the purchase price. And we should say also that in some businesses and in some transactions, there can be what's called a target net working capital in the agreement instead. So rather than being paid or credited piecemeal for these balance sheet items, a buyer may set a net working capital target of 200,000, 500,000, some figure that's often based on your historical business average or some industry metric, and they'll require you to have that level in the business at the closing. This typically excludes cash, But effectively, if you have, say, $600,000 of net working capital in the business, excluding cash, and the benchmark or the target is 400,000, that difference, the $200,000, would be paid to you over and above the purchase price. Or if you're short, again, there would be a reduction of the purchase price for that net working capital target. And then the final item that's on your balance sheet that we don't talk about in the purchase price is debt, long-term liabilities. So if you have notes outstanding for vehicles or a term loan or other debts on the books, an asset sale is meant to be transferred free and clear. So in that case, you'll need to be paid off. You'll need to have these debts paid off at the close or prior to the close. And that's typically done out of the closing proceeds in a wire at close, but you can also do a payoff prior to the transaction. So these are kind of the pluses and the minuses that come off your balance sheet in an asset transaction that you may not have considered in the purchase price itself. And from here, we'll get into the next of our buckets, which is transaction costs and then taxes. So I'll hand it over to Danny for those.
All right, great. So your transaction costs are typically, you're paying certain people hourly, you're paying others, based on a percentage of, EV or enterprise value. Those fees, for a deal should run between like 5 and 10% of total enterprise value. And then we are going to go through 4,000 level M&A tax in 4 minutes. So when so this is how the cash flow is going to work at closing is you have your EV, then you have a bunch of deducts and adds. One thing I'll call out here is the holdback. The holdback is for indemnities, and you should expect to get that paid to you after, 1 or 2 years, whatever's negotiated. And so we'll cover that item later. But for here, you're essentially they're the full value, like the headline value is 10, you're clearing 8, and then we'll move on to the taxes next. Can you go to the next slide? So we've assumed a pass-through entity here with no, essentially zero tax basis, which would almost never be the case. That's once again why this is just an illustrative example that you should not really use for anything. But the IRS requires you to allocate value based on fair market value, and so these are typically done by outside valuation firms. What they're really valuing, is the other, so the M&E, the real estate, and then the intangibles, inventory and AR kind of have generally known values unless you've got some ugly old books in there. But the seller, as you can see here, wins and loses by where value is allocated. Obviously, any seller would want to push more value into capital gains. But once again, this capital gains assets, but once again, this has to be done at fair market value. So that kind of dictates. The one item that we'd like to call out here, especially as the BBB is back, is mostly 168K bonus depreciation. So if you go to class 5, you can see capital gains except recapture. And so that recapture is essentially if you depreciate assets heavily and then you receive a higher value for it, the IRS, you've been essentially depreciating. So you've been writing off depreciation against your ordinary income. And so you're going to get taxed at the ordinary income for that differential. So yes, 168K bonus depreciation is great as a write-off, but if you turn around and write these assets off and then flip them, the IRS wants to get their money back, essentially. Let's see what else we have here. So yeah, this is just federal long-term or federal tax. In here, I put some state tax in. State taxes trend in the 20% of Fed, depending on which state you're in. So that's also in here. And then one thing that we left out, and this is something to bring up for silent partners, is there's a net investment income tax. If you are not active in your business, you get hit with a 3.8% surcharge. It requires you to be over modified adjusted gross income of certain levels, but if you're selling a business, you're gonna break that number. And so that's also something to be wary of. Your non-active partner in the business. And so all of these items come together, you pay your taxes, and then something that I'll breeze over here is on the holdback. Depending on how the holdback comes in, and your tax timing, you could just file one return with the holdback in it if your years like work correctly, but oftentimes it's an amendment, and you'd have to go back and pay tax on that when you receive it. Um, and so, yeah, I guess the point here is really, know what your business is comprised of, be able to, generally ballpark it, and then work with a competent CPA to project, what you'd actually clear upon sale. Um, and I think that's all we got. You got any more, Griffin?
No, absolutely. I think in our example here, as you can see, we started with a $10 million purchase price. After factoring in our balance sheet items, including paying off debt, and then going through our tax example here, as well as the holdback, we're at about 6.2 million in take home. Obviously, every business is different. Your purchase price allocation will be so critical to this. Your balance sheet situation will be so critical. So again, it's really important that you work with strong advisors, both on the purchase side and then after the close, your accountant, your lawyer, to make sure that everything is tracked and tied down correctly.
Forward, we want to do questions?
Yeah, great. Thanks for that presentation, guys. Very informative. We've got a lot of questions in, and we're going to do our best to answer all of those. And just wanted everybody that's watching to know that this presentation will be made available online in the next couple of days. So if you've got to jump or had to leave early, you'll be able to go back and review this material. So the first question we have is, what percentage of tax do you pay on capital gains at the sale of a business?
That's kind of confusingly worded, but capital gains is stratified based on how much gain or how much income you have in a year. So it's somewhere between 10 and 20. Typically, if you're clearing a material amount on your closing, you're going to pay the 20 for the full, mostly 20, because you're going to be clearing so much money that the 10 and the 15 tranche don't even really register for you.
Great. The second question we have here is, I have a personal loan from a family member that is running through my business. Do I need to pay off these loans in order to sell?
Yeah, that's a great question. And typically, any bona fide debt that's in your business does need to be cleared and paid off at closing. So whether it's from a family member or a third party, you're going to want to get that taken care of before closing, or paid off at the closing out of the closing proceeds.
Terrific. Another one we have here. Which is better, owner financing or cash out lump sum at close?
Yeah, so there's actually, I mean, this is more of a preference question. If you want to get the lump at close and start investing, I will say, there is some minor tax advantage to installment sales, but I think liquidity is going to be the primary concern there.
Yeah, but that'll really it'll depend on who the seller is and what they're comfortable with and their priorities in most cases.
Great. When a company is preparing for a sale, what should be the primary focus to ensure the best outcome and income potential?
I can start and then you can jump in if you want, Danny, but really making sure that you have strong and well-documented earnings in the business should be the highest and best use of your time and you're preparing for sale. Having a high percentage of your business come from recurring sources, whether those are contracts or just customers that are repeat business year over year, making sure that is that's happening and that you can prove that is really important to making sure that you have a successful sale at a price that you're happy with.
Yeah, to add to that, I think the key component is to prove that. And so having clean books and records, like we were talking about this actually before this presentation. And like, if you don't have great books and records, you're going to end up paying this horrible tax rate that we had right here because you won't know what your basis is. And so that's something, just having good books and records to prove it.
Terrific. Great advice there, guys. Another question we have here. What if the buyer doesn't want your inventory at sale? Are you stuck with it? Kind of walk us through the implications there. Not typical, I would say, but curious.
Yeah, if the buyer has no need for your inventory or just doesn't want it for whatever reason, those are in theory assets that have value. So the seller could, in that case, retain the assets. Sometimes you can return them to supply houses. You could sell them, through third-party platforms. You could look for another operator in your area and see if they're interested in purchasing the inventory. That would be an unusual situation, but there are still ways, I think, to get value out of that in that case.
Terrific. Another question we have here, are vehicles included in the purchase price or are they allocated separately?
So vehicles are one of the fixed assets that's typically always included in an asset sale of a business. Those are hard assets that are used in generating the earnings of your business, and therefore they would be incorporated in the purchase price in almost every case.
I think we have time for about one more question here. This is, does it benefit your company to switch from a C Corp to an S Corp prior to selling your business?
Yeah, I mean, if you got 5 years, isn't that the rule currently? With QS, and this is once again, your situation will matter a lot. Do you want income? Are you solely focused on selling? There's the new QSBS that came up in the big beautiful bill as well. And so if you qualify for QSBS, the C Corp can be great, but qualifying is really hard. And so, we see a lot of pass-through entities, but ultimately it's up to like what you're trying to do. I guess, Griffin, do you have anything to add there?
Yeah, I would say that typically we do see most sellers, I'd say most, have a benefit from being an S Corp over a C Corp. As Danny said, it does take 5 years to establish that before you can transact. That said, the delta in tax liability we've seen shrink since the 2017 tax bill versus, it was a much larger gap before. And there are strategies you can employ, QSBS, as Danny mentioned, and then personal goodwill are other avenues that you can go down to reduce your tax liability as a C Corp. So regardless of what your situation is, you should just talk to an advisor who can help you decide what's best for you.
All right, and one last question here. How do you treat real estate in a transaction?
I think on a case-by-case basis is really the answer here. Some buyers may be interested in purchasing the real estate of your business. Others will have a preference to lease it, and some may not want it at all. They may not need it. So in some cases, it will be wrapped into the purchase price if it's a critical asset of the business that's being sold. In other cases, we see buyers lease the property from the seller, and the seller retains the real estate in a separate entity. And then sometimes we just see it left out, and the seller can do what they want with the property, sell it, keep it, lease it elsewhere. There's a lot of different ways to sort of skin that cat. So it's definitely a case-by-case basis.
Terrific. Well, thank you everybody for your time. Griffin and Danny, thank you for your insights. Once again, this webinar is going to be put up online in the next couple of days if you want to go back and kind of reiterate some of the information that Griffin and Danny have shared with us all. And thank you all again for your time.
Thanks, everyone.
Thanks all.